big hello and a very warm welcome to Brand Equity with me, Sonali Krishna. One of India's oldest packaged consumer goods company, Dabur, is suddenly buzzing with action, be it the acquisition of Badshah Masala, marking its entry into the over 25,000 crore branded spices and seasoning market in India, or dipping its toes into India's buzzing D2C market. Well, I'm joined by the CEO of Dabur, Mohit Malhotra, to discuss just that and also a myriad of subjects which include inflationary pressures, outlook of the FMCG sector, rural woes, and of course, everything in between. Thank you so much, Mohit, for joining us right here on Brand Equity.
Thank you, Sonali, for having me. Thanks a lot. Yeah.
I want to start by saying it's definitely been quite an adventure for you, given that you took over this mantle in 2019 and you've just been hit with headwinds after headwinds. Just as COVID is easing out, we're suddenly seeing inflationary pressures, margins being squeezed, consumer sentiment being a bit muted. How are you dealing with all this?
I've been in this industry for almost more than around 25 years. So I think it's been a roller coaster ride since I joined the industry. So it was no easy when one was in international business also, and it's not easy now. So one has kind of gotten used to this roller coaster ride, and it's okay. Now we are taking it as a par for the course, all the turbulence which is there, and we know how to thrive in turbulence. Actually, Dabur is one company which thrives when there is turbulence, when there is status quo and everything is all right. We guys don't do too well. We do well when there is a lot of turbulence hitting us. So we are in markets like Nigeria, Pakistan, Bangladesh. So wherever there is turbulence, Dabur thrives there.
Mohit, everybody expected a big buoyancy post-COVID just because we just got back our freedom, and we did see that. But unfortunately, would you agree with me that that run has been very, very short-lived, and we're going back into a tense environment where the future is not looking as optimistic as let's say it looked 6 months ago?
Yeah, I don't think that things have actually gotten worse. If you actually go back pre-COVID time also, we find the FMCG market was actually not doing too well. From the peak, it actually flattened out, and then suddenly COVID hit us. And when the decline was minus 25 to minus 30%. And so we are kind of back to the pre-COVID levels. So I would not say that it's very starkly down. And so we're back to pre-COVID. And from here, we're almost bottoming out. From here, I think the only way is to go up. And there's a captive strength in the country like India. So I think things are not as doom and gloom as they look. So I think from this bottoming out of the market, things will only look up as we go to the lower bases, and the growths will once again start. Yeah, that's my view.
I want to now dive into your acquisition of, Badshah Masala, a very interesting move, and also coming at a time when, it seems like the FMCG sector suddenly woken up to acquisitions. We've seen, lots of action in this space after a while. How long were you planning this acquisition, and why do you think this is very key to your portfolio?
Yeah, so I think first to the sector. So suddenly the sector has become very resilient to the acquisitions because the valuations have become a little reasonable post-COVID. So during COVID, a lot of companies were actually hit, and wherever the P&L strength wasn't there, the balance sheet wasn't strong enough. So they've kind of declared some losses. And because of that, the valuations across the sector have become more reasonable. And the appetite is therefore there to take on some synergistic targets. As far as Dabur is concerned on Badshah Masala, we have been deliberating with the owners for almost 5 years now. Yeah. And only after post 5 years could we actually get the deal on the table. There was internal little drift in the family as it kind of got settled in. Only then could we think, but we have been working with this company for a very, very long time. And there wasn't a process that the company ran. So it's an internal dialogue which finally consummated into a tie-up between us and Badshah. So it's still not a 100% deal. So we've only acquired 51% stake to have a majority say. as far as the company is concerned on the board, and 49% is still retained by the promoters, because we will be needing them to handhold us to navigate this newer market as we enter, because a lot of relationships in this category are very sticky. And to understand those relationships, you require a proprietor to handhold you as we take the balance in next 5 years' time.
Why was the branded spices and seasoning market attractive to you? And secondly, if you're saying that, if valuations have become more realistic and reasonable, what are the other spaces you're eyeing to get into at this point?
Yeah, so, if you look at the food and beverage space, we did a proper due diligence of a lot of other categories using a specialist consultant come in and evaluate all that for us. And we found that there are very few categories in food and beverage which are margin accretive, where the gross margins are healthier, which are pretty much in line with the personal care gross margins. And spices and condiments market, masala market was one in which the margins are pretty good as compared to the food sector margins. As far as Dabur is concerned, so that was the shortlist of the market, and the how we evaluate entry into the market, that there has to be a size of the market which has to be significantly high. So masala market in India, whether branded, unbranded, is roughly around 60,000 crores. Out of 60,000 crores, around 25,000 crores is the branded market. And this unbranded to branded shift is happening across food sectors in India. So every sector, which is essentially unbranded in the country, and 60% of FMCG is food. And the food sector is at a very fast pace becoming branded. As rural India becomes more urban, the unbranded market will become more branded as the disposable incomes in the country will go up. So this spices market presented a good opportunity of a tailwind of growth, which is going to be there as the market moves from unbranded to branded. So it's a market which is growing at around 20%. And within this 25,000 crores, 50% is straight spices and 50% is blended spices. Straight spices are more commoditized, and blended spices are more like a brand, like a Badshah present in it. And Badshah's 80% portfolio is more of blended spices, or I should be saying value-added spices. So it made eminent sense for Dabur to get into this category because it was value accretive to our foods portfolio, our food and beverage portfolio. So yeah, the market valuations, second part of your questions, market valuations are becoming reasonable. Yes, they are. So reasonable at every end, at the mass market companies and also in new startup spheres. As you know, a lot of startup companies earlier had a lot of funding from private equity, venture capitalist play. And as the profits don't come in, earlier they are a pure play D2C or a pure play e-commerce. So as they wanted to scale up from e-commerce to the main FMCG, brick and mortar kind of mom and pop stores, you require a lot of funding, and a lot of VC funds and private equity funds have actually dried up. So as they get into losses, so they become available for the organized sector to pick them up, at least take a stake in them, and therefore a lot of strategic companies are getting into this.
Thank you for that, very insightful answer. I just want to shift gear and talk to you about, how the rural economy is doing. The growth in, real rural wages is pretty down. We're witnessing a lot of credit and liquidity pressures in the rural markets. How are you finding the performance? Are you witnessing a decline, significantly in the rural markets, and are you seeing progress in the urban markets, at least at the premium end?
Yeah, so the two parts. I think as far as the sector is concerned, the urban markets are doing well, and urban markets are doing well on back of surge post-COVID of e-commerce as a platform. For us, e-commerce is now contributing roughly around 9% of our total business, and the growth in e-commerce is around 50% for us. And this has been happening quarter on quarter on quarter. If I look back around 4 years back pre-COVID, e-commerce contribution to our business was 2%. From 2%, it's got scaled up to around 9%. It's consistently growing. Then comes modern trade. During COVID, as you know, due to the lockdowns, modern trade was almost shut as a segment of business. That has opened up, and people are doing revenge purchase and they are moving out. So modern trade is also growing by around 20%. So out of the total market that we cater to, e-commerce contributes to 10%, another 10% coming through modern trade, 20%, which is around 50% of the total urban consumption, is growing at a very fast pace, both organically and inorganically. So there is a D2C space, there is acquisitions happening, Big Bazaar, Reliance, and cash and carry. So a lot of movement and flux happening in this entire category, which is leading to huge growth. So that's the urban story for us. 70% of India's population resides in rural, and rural contributes around 40% to the industry, 30 to 40, depending upon in which market a company is operating in. For Dabur, it is almost 50% of the business coming from rural, because we are also very rural dependent as an organization. So for us, rural was firing very well, but for last quarter. And after around 7 quarters, I think in a row, we've seen our rural business is now a little behind the urban business. Only in last quarter, we saw the rural business flagging a little bit. And that is because of credit crunch in the market. We are seeing liquidity pressures at the retail level, and that is because it's taking its root into the inflationary price increase, which has been happening by a lot of companies. So companies have done price increases. The price increases is flowing into rural India, and the impact of price increase in rural India is much more than urban, because they thrive on 5 rupee, 10 rupee, 1 rupee, 2 rupee cash rings. And in cash rings, either there's a shrinkflation wherein marketing companies reduce the pack size, or they breach the price point and release some bridge packs. So the impact of price increase is much higher, and therefore it squeezes the disposable income in the wallet of the rural consumer to be spent on discretionary. So discretionaries are getting impacted, food not so much so, and we are also seeing that pinch happening in rural India. But as you know, this is very cyclical. The consumption in rural is here to stay, and will come back as it cycles the high base of the inflation, which is what is hitting us actually. So I don't think it's a long-term short story. It's a couple of quarters more that rural pinch will be there. And after that, we should see a bounce back of rural.
I just want to talk to you a little bit about the lower income households. And yes, inflation has burnt a hole, in the pocket of India's lower income households. And you must have seen that they've been spending less in the last few months. Would one say that consumer companies such as yours and others are seeing sales and volume growth in their premium products, while volumes in value buys are truncating?
Yeah, so therefore I was saying e-commerce and modern trade doing well. So therefore these segments or these channels of sales actually cater more to premium. If you look at e-commerce, they encourage, high ticket prices for packs. So therefore what you sell is something which is greater than 300 rupees. So when it is greater than 300, it has to be premium, looking at the overall per capita income of the country. So e-commerce caters to premium, modern trade caters to premium, and the cash and carry players, because the bulk purchase, they also cater to premium. What is left is the middle India, which is where the pop and mom stores come in, where low unit price points are actually doing very well, and the higher unit price points are not doing so well for us. That is a significant indicator that consumers are down trading to lower packs, and a consumer who used to buy a 500 ml is now buying a 300 ml pack. The person who was buying a 100 ml is now buying a 50 ml. A person who is buying a 20 rupee is now shifting to a 10 rupee, and which is what is visible in the middle India, and which is a barometer of how the economy is kind of behaving. But I think it's all temporary, and things will change very soon. The way it's going, and every quarter on quarter we think that a situation is actually becoming better.
Am I right to assume that you have a very optimistic view of 2023?
I should not say that a very optimistic view. I would call that not optimistic or pessimistic. I would call that very factual and what we see as numbers. So, to me, for the choice of the right word, it's more, I think, a pragmatic view that things are bottoming out. And I think this quarter three should be the last quarter. And from quarter four onwards, we lap over the high basis of last year. So, the growth should actually start trending up as you go. And next year onwards, we should see high single digit kind of growth coming in, which is a combination of both price as also volume. And that should kind of come in, yeah. And we're also keeping our fingers crossed. Hopefully, things will be better. Because, this year, what was a little different in the current year is that last year was a COVID year. And in COVID year, very peculiarly for Dabur and only for Dabur actually, the healthcare tailwind was very high. COVID contextual products, what we call them, were very high for us. Like Chyawanprash sold very well because of immunity and people wanted to buy. So, the entire shelf spaces were filled with Chyawanprash. Honey did very well. A lot of smaller players saw healthcare as a market very attractive. So they kind of got into it, increasing the size of the pie. Although we as an organized company got a lot of tailwind because of this. So we gained ground. Because we gained ground and increased our market share across 95% of the portfolio, the base of the business in healthcare has gone up. And we are traversing that base. On a high base, our growth in healthcare as a segment which contributes to 30% of our business may look a little muted. But if you calculate the 3-year CAGR, pre-COVID to now, we have a 10% growth, which is like a pre-COVID growth for us. So we think it should go back to that kind of levels next year, 23.
You're also very bullish, and venturing very aggressively in the direct-to-consumer space by launching your own website, Dabur Shop. I'm curious, we see a lot of FMCG companies do it, but, if I just look at myself as a customer, and let's say that I'm a, Dabur loyalist, wouldn't it be more convenient for me as a customer who is buying FMCG products to go to an aggregator rather than go to every particular FMCG company's own platform and buy it?
So, Sonali, what you're saying is absolutely right. Obviously, not every consumer would download an app from every company and flood his, mobile with all these apps. It's not possible. But Dabur is very unique. We are not a company which is like other companies. We have a very natural, herbal, and Ayurvedic kind of a positioning, and the product portfolio is very different. That's why we are diversified. We have got a portfolio in healthcare, we have a portfolio in home care, in personal care, in oral care, skin care, also in foods and beverages. So we are kind of becoming a full-scale organization which caters to all needs of the consumers. And we have a SKU list of more than 500 SKUs. So it's physically not possible for any grocer to stock our entire stock with him. So therefore, there are distribution compromises which actually happen when you go and distribute, despite we having 3 feet on street, one for health, one for personal, one for foods, going to the retail outlet and selling. So we feel that while it may not be a very profitable or a commercial venture, but from a consumer convenience standpoint, it's very important for us to create a D2C site where the entire gamut of our products is available, including Ayurvedic medicines. So we are also like a doctor shop, we are like a full-scale Ayurvedic medical shop, along with the personal care, home care, foods. So we are very different than any other FMCG company who would only cater to a confectionery or only a home care, etc., etc. So for us, it makes eminent sense to have our own shop. And we are in the process of doing beta testing in a couple of regions. As we iron out the issues which are there in beta testing, then we will scale it up to the entire country. But we feel that it is something which we must have going forward long term, looking at the entire portfolio that we cater to and the core competency that we have here. So to be able to give the consumers what we have in our stable.
It's going to be an interesting time in the FMCG space as you have, FMCG majors such as the Tata Consumer Products, ITC, and of course, we have the big giant, which is the Reliance, also making its way and aggressively looking at the FMCG space. Do you think we're heading in for a price war? And will companies be able to stomach this price war, given the fact that they're already, under a lot of duress, given the macro pressures?
Yeah, so I don't think there will be price war. So there are two parts of this question. One, a part of the question would be how would Dabur handle it? As far as Dabur is concerned, again, we are very clearly into health, Ayurvedic, wellness space, which is very differentiated, where we have a right to win, where consumer also grants us the credibility and the equity to be in that area. That area is very specialized. And not every company getting into this area is successful. Like in COVID, you had a lot of companies making Chyawanprash, but then Dabur market share of Chyawanprash went up some 500 basis points, despite so many companies coming in, because the benefit of the entire share of voice increasing in the category was granted by consumer to Dabur only, and our Chyawanprash sales went up. Similarly, in honey, a lot of companies came in and then went out, and Dabur's market share have actually gone up. So we leveraged this tailwind. So what you call a commodity warfare, which will happen now, this is bound to happen with Reliance coming in. Reliance has got their own stores and they are getting into brands and they're doing consumer acquisitions. My view is they will launch private label brands. But private label brands have been there in other developed countries like US, UK, which are much more developed markets, have always been there. But this is the space of commoditized categories like home care, etc., where consumer has 5 to 6 to 10 brands in his consideration set. He doesn't mind testing one or two brands. But in the personal care category, in healthcare category, in skin care, oral care, I think consumer doesn't believe in trying out multiple offerings by companies because they are pretty loyal to it.
Can I then assume that given this place hotting up with, the Reliance and Adani's and, what have you, that we'll see an increased focus by Dabur in terms of its brand building and its marketing efforts to ensure they're top of mind and you remain that loyal, trusted brand in your consumer's mind?
Yeah, so Dabur past 4 to 5 years, I think pre-COVID also, we became very aggressive, but COVID actually provided a step change in the way we've handled the business, especially our new product innovations. And I feel the new product innovations are, the way to keep the consumer companies in line with the changing tastes and preferences of the consumers. So therefore, NPD and new product innovations and renovation and innovation become very integral part of, being in tune with the times. So therefore, our NPD ratios were as low as 1 or 2% around 5 to 6 years back. Now it's in the range of around 4 to 5%. And I think we are very aggressive. So that's one vector of change which has actually happened for us to get very aggressive in terms of innovation and renovation. The second vector is we are also aggressive in terms of our rural reach. So we are continuously reaching out to newer number of villages and got this Yodha program in which we appoint village level entrepreneurs and we make them stocking points and we scale up the business and then we convert them into sub-stockists and stockists, etc. So that expansion of rural reach and also reaching out to urban consumers in a more effective and efficient manner is also, and through digitization, is what we guys are doing. So that's a second leg of aggression. The third leg of aggression is we are recruiting in a lot of young talent from laterally and also from B schools now. And that is also helping us to keep up in things in tune with the times and get more aggression because hierarchies are being destroyed in the organization and promotions are given depending upon the merit. So all these things, we are getting aggressive. And if you don't get aggressive, then there is no way that we can maintain or increase our market shares in the market.
Absolutely. Very, very, very clear answers and very insightful. Thank you so much for your time, Mohit. And here's wishing Dabur and you lots more power as you get more aggressive and as this market hots up even more. Thank you so much.
Thank you, Sonali, for having me, and wish you all and the entire team of Brand Equity a very, very happy new year and a great festive season.